Hello viewers, this is Dr. Abraham Joseph from Money Matters. Today we are in the third part of Introduction to Share Market Trading. Yesterday we studied about the advantages and disadvantages of stock market, and today we shall concentrate on the types of products that are traded in the stock market. Basically there are two types of products that are traded. One is called equities, it's also called as stocks or shares, and the second one is called as derivatives. So we'll be studying in detail about these things today. Welcome viewers. Today we shall study on the various types of products that are bought and sold in the stock exchange. The products that are sold in the stock exchange, basically there are two. One is called stock or equities or shares. First, let us study what are the characteristics of stocks. Actually, these stocks or shares are of a public company and which are transferable. Anybody can sell it through the stock exchange or through the broker. One of the main characteristics of this stock is it has got a face value. Normally, the face value varies. Sometime it will be 10 rupees or 5 rupees or 2 rupees or 1 rupee. And it has got a market value also. Market value is based on the market forces of demand and supply for that company's shares. So face value, for example, Ashok Leyland is a popular automobile auto company. The face value of its share is just 1 rupee, and the market value of its share is today is 210 rupees plus or minus 1 or 2 rupees. On the other hand, MRF, Madras Rubber Factory, its face value is rupees 10 and its market value is approximately 1,12,000 rupees, something like that as of now. And these shares can be bought and sold only through Demat account. You cannot directly buy it. You can buy any number of shares or you can sell any number of shares provided if you have the capacity to buy or sell based on it. So it's on a delivery basis. You pay and you buy. You get those things in full. You don't get in partiality, and you become the owner of that particular share. So when you become the owner of the shares, it's just like a property you hold. You can hold it as long as you like, or you can sell it whenever you want also if you think it has earned enough amount of profit. And because you hold shares, you become a partial owner of the company, and on account of that you get dividend if the company makes profit, and you get bonus shares if the company declares bonus, and you will get provided the company makes profits. So it is normally in the stocks the people are trading in the stock market, considering its price and PE ratio and number of other factors which you will study in the later course. The second part of the share market product is called derivatives. Now what is derivatives? Basically there is only one, that is shares. So derivatives are the product that are derived from the underlying asset. Say for example, from milk we make butter, we make ghee, we make various other products. So milk is the main product. Similarly, share is the main product, and from the shares we have these derivatives, either it is option or futures. So in the derivatives there are two types of derivatives. One is called options and the second one is called derivatives. In options again there are two types. One is called call option and another is called put option. Call option is called CE and put option is called PE. What is call option? If you think the price of the shares, price of a equity or a share will increase in the future, that means now the price is less and in the future it will increase. What you will do is you will buy in anticipation of the increased price in the future. So you will buy at a lower price and you will sell it at a higher price. But this should happen within that specified date. You have got an expiry for all options. So you will say, for example, by the end of this month, a particular shares price will reach from 100 to 110 from the present 100 rupees. So 10 rupees, if you think that it will increase, means you will get that as a profit. So normally options are traded in the indexes as well as in future stocks on the price of that. One of the important characteristics of the option is that it has got an expiry day. You can leverage. You have to buy it in lot size. You cannot buy one or two, and you don't have the ownership of that. It's just like you are taking the shares on a rental basis for a few days. You will not be paying the entire amount. You will be paying what's called a premium normally, and the premium can become zero also by the expiry date. That's why many people, though they know the risk involved, they trade and they lose huge amount of money. Hardly, as per the SEBI's presentation, only 5% of the people make money from options and futures. Remaining 95% lose the money in investing the options. So we'll study about that in detail. But there are people who are expert in this one who invest in large sums of money in crores and crores, and they make money. They lose equally the amount also. But it requires a lot of training and a time involvement. In case of shares, you can buy, and especially if it is a long-term holding, you don't have to sit in front of the system. But in case of futures and options, you have to sit in front of especially in case of options, you have to sit in front of the system to see whether it is making profit or not. So one is call option. So you think the price will increase and you will buy, and when the price increases, you will sell. For example, you in anticipation of increasing the price, you will buy, and the price comes down, you will suffer loss. So if you think that the price is increasing, you are buying what is called a CE, or it's also called a long. You are buying long. And in case of, if you think the prices will come down in the future, that means today the price is 100 rupees, and in the future the price will come to 90 rupees. So what you will do is you will buy PE or you will buy short, it is called that way. Then in the future, if the price comes down, you will make profit. So this is a little complicated to understand it, because it requires a different mindset to understand that one. But if we are conducting the classes in the future, we will tell that in detail. So then what about futures? Futures means there are around 250 stocks that are identified. You can trade in the futures. In futures, what you do is you, again the same conditions, in anticipation of the price changes that you may expect in the future. Say for example, Infosys today is approximately 1,500. You think the price of the share will go to 1,600 by the end of this month. You will buy the futures of Infosys today, but you have to buy in lots. Maybe the lot size of that may be around 300 units. So 300 units into 1,500. So it comes with a leverage value. And or else, if you think the price is coming down, so you can buy today 1,500. If you think it comes to 1,400, you can buy accordingly. And if the price comes down, you will make profit. But here you will not lose the entire amount, but you will lose only part. But in case of options, there are chances that you will lose all the money that you invested. So this is all about today's products, two main products. So especially the beginners should concentrate only on equities. Once you are experienced and you have made enough money from the primary market, from the equities, then perhaps you can think about jumping into trading the options and the futures. So especially you have to wait for 1 or 2 years to do that. Okay. Thank you very much. Have a wonderful day.